It's on.
Yeah. Yes. Hi, everybody.
Good afternoon, and it's that time of the month each month.
Yes, it's stats for Staten Island for November.
Right. So we're going over December stats, basically, which is November's data, because it lags by a month. But anyway, let's. It's the holiday season. Hopefully, everybody's all prepared. Did you do your Christmas shopping?
I'm still doing it. I'm not quite done yet.
No?
No.
What's left? Let's put you on the spot.
Just a couple things.
Just a couple of things.
What about you?
No, not at all.
You're not.
I don't think I even began. But, and traditionally in the past, I used to kind of wait for, I would be the person that goes to the mall on Christmas Eve. I was that person.
There's nothing left when you go that late.
Yeah. So I had slim pickings. I had to go for the whatever was left over, but I would be there on Christmas Day. I'm a horrible procrastinator. It's the Libra side of me. Anyway, so how's everybody doing out there in TikTok land and Facebook? If Facebook ever really resonates, seems like every few weeks when we touch on a controversial topic, the next two lives are basically off the radar. It's crickets. But anyway, so let's get into the numbers and see what we got going on for the last month.
Yeah. So let's start with the average days on the market. So the average days on the market are down almost 7% year over year, but up 6.15% month over month.
So basically, year over year, this is the funny thing. Rates came down last year around March, so there was quite a robust buying season. March was it's kind of funny because things kind of upticked, in March of last year. There was a big rush. Rates actually got down as low as 5%. So year over year, I think March was a really big bounce for the market. We have to see what's going to happen going into this year, because I think we're going to see some of that bounce. The Fed's scheduled to drop rates once again to maybe another quarter point is coming down, I think. I mean, it's about, I believe the last time it was checked, it's like 80%. And, there's one of these things you can get. If you guys haven't seen it yet, Polymarket is like one of those things that they do. There's betting odds. It was big in the elections. It was big all around. Polymarket's like the public sentiment over whether they're going to make a change and things like that, if they're going to lower it. And I believe some of the sentiment is that it's 80% chance they're going to lower rates. One of the interesting things in the latest CPI data was that inflation has made a little bit of a comeback, and it's I believe they're going to lower rates anyway, but the last two reports have said that basically have come up a bit on rates. So with that being said, because we're coming up on rates, there are some people who may think that there may be a pause in the Fed's decision to raise rates, lower rates a 0.25%. It doesn't really necessarily affect mortgage rates per se. This is one of the stranger things that kind of have happened. Because inflation's kind of remained sticky, the 10-year Treasury, which is a determining factor in mortgage interest rates, has actually, even after the last rate cut, had come up a bit. And then the last few days it was down, and then today again I saw it was kind of spiked up again. And that's really one of the interesting things is like, where are we going as far as a balance in terms of, are we going to really deal with the inflation that we have that seems to be, there's a couple of things there's a couple of things that concern me about where inflation's heading. And you could see there's certain asset classes, obviously Bitcoin, if we know is one of those things. Is now, I think as of today, it like jumped over the 101. It's floated around the all-time high, and usually that is a very good bet on inflation to a certain degree, not 100%, but it's definitely pointing. And just so you know, one of the interesting things about the Bitcoin price and house prices is that they've generally correlated with each other. They've worked in conjunction. We've seen, that's what makes this year a lot more interesting, is that the sentiments between markets in general, as a general sense of things, is that things are going to accelerate. So there's like, but that is the pressure that's going to be on inflation moving forward. And if there is inflation, it's going to bring up house prices once again. I definitely think that it's going to be one of those things that house prices will may come up a bit coming into the new year based on the data. So one of the things is the cumulative days of the market year over year was down 6.76% because basically for the year, different from 2022 to 2023 to 2024, is that for the most part, 2023, the rates were higher throughout the year than they have been through 2024. That's the mortgage interest rate. So, and it's being reflected in the days on the market, which has come down fractionally from 74 days last year, right? You had mentioned it's down 6.76 for the year.
Yes.
And it's nominally down to 69 days, which is so-so. It's not like the biggest of deals, but we'll have to see how that plays out. But I do think we're going to be hedging our bets in terms of where we're going from here.
So next up I have is the month's inventory. The month's inventory is down year over year, 26%, and the month over month is up 8%.
Yeah, that's interesting. That's an interesting year over year. That's considerably down, a whole 25%. So this is again, when we talk about month's inventory, we talk about how much basically the inventory that's currently on the market would take to sell off. Being 25% down year over year is pretty considerable. Meaning that it's still pretty much, and when I say seller's market, it's not saying that every house is one of the biggest problems we have today is overestimating values. It seems like a lot of people overestimate values considerably. And I think it's become it gets a little bit too far, and people are kind of disappointed when things don't happen. But it is true that this remains reflective. Now, November 2023 is approaching 6. Now it's down to 4. 6 is like the teetering point. 6 months inventory is like the teetering point for a seller's market, the buyer's market. And it came close last November. And that was mainly due to interest rates last year to this year. But I'm going to say this, is that when you talk about the volume of sales, that could be a problem moving forward. And that's really the interesting thing. How much would new listings impact days on the market, a month's inventory? So even if people feel good, it's not the volume of sales that I say really support much of an increase in the way of inventory without affecting prices. So that's my take there.
So I have a question for you. How have recent economic changes influenced the Nope, that's the wrong question, sorry. What is driving the significant year-over-year drop in months inventory?
It's interest rates. I mean, basically, the year-over-year decrease in months inventory, we touched on that for a little bit. Again, very few houses on the market, and a uptick in sales, which actually reflected at 17. There's a 17% uptick in sales from a year ago.
Yes.
It's marginal, but it doesn't take much to move the needle when you have this view of data. So things will appear to be a lot greater in terms of like the data, and where it doesn't take much for like the house prices to kind of go like the sold to list price to teeter up a bit based on a few additional houses on the market. Because again, we're dealing with very low sample sizes, so a little bump here or there seems to be much more profound when you deal in this. It's a smaller market than it was 4 years ago, and we'll get into that later when we talk about sold listings.
Yes. So next up I have is the sale to list price ratio. The sale to list price ratio has went up year over year, 0.62%, and month over month it has also went up 4.1%. So it's at 98.1 right now.
So basically, it's only about generally of the houses that do sell, if they sell, they're getting 98.1% of the sales to list price ratio. Mm-hmm. So from where the list price was to where it actually sold that month, basically was the determining factor. So it's really a key to knowing exactly where sentiments are. So it's been on the increase. Mm-hmm. So, and it's marginal. It's a 0.5%, not huge. But if you're out there buying, you should realize that, when you look at sales to list price ratio, and everybody in real estate should kind of know this, it should give you an indication of where you could be offering, where it's likely to go. You want a range within, 2 or 3 points of the sales to list price ratio on any house that you may be considering. Obviously, there'll be some exceptions. A smart realtor will know what those are and tell you where to bid appropriately. But you're not getting a big discount, and that's really pretty much that's the main part of it.
And now these sold medium listings. These sold medium listings are up year over year and month over month. So year over year it's up 5%, and month over month it's up 0.90%.
Yeah. So 0.9% on the month over month. So that means people are buying up a little bit here. So year over year, people of the houses, well, they're putting their house on the market for more, on an average of 5.21%. And unfortunately, that's exceeding the average sale price for the average sale price and the median sold price is not reflective of that. So people are they're putting on the house with definitely a little bit more exuberance than I would say typically that would support the sold median listing at 5.21. People are willing to move up in price a little bit, but this will be a challenge. The affordability issue is still the key. Any uptick in rate rates, we've seen it 1,000 times, any uptick in rates is basically a harbinger for the market to come down. And we've seen the points last year, prices have come down when the rates have, gotten too far over 7. And as they approached 8, the market would absolutely go in the opposite direction. So that seems to be around 7% seems to be where the market kind of teeters. It will be pretty stable at 7%. You start going over 7%, all of a sudden everything changes. Now that's for our market. For other markets like Florida and things like that, where there are some sections of the country where prices have come down. It's not happened here, and in New Jersey, it's happened even less. But parts of New Jersey, but it's an interesting time. Interesting time for a home buyer. you know, I must have, like in the 13 years I've done this, every home buyer I kind of dealt with this, we'll wait a little bit. But we'll wait a little bit to buy. Prices, I think, are going to come down. It's not really, I thought they would come down a bit if rates stayed where they were. And that's going to be a situation that we'll get into at some point, where we think this could go. Mm-hmm. But as far as I'm concerned, this report basically doesn't have much in it that's going to say we're going in one direction or another. It's pretty stable overall.
Yep. The next is pending average listing. Pending average listing has increased year over year, 2.47%, and month over month about almost 4%.
Okay, that's the pending. Mm-hmm. So people are willing. So here's where the difference: the sold median listing, and the pending average listing has come down just a bit. So it's come up, and it's come down from the 5.21 to 2.47. So these are the houses that are currently pending. As far as people who have these houses in pending right now, are coming up about 2% on the price when they go into pending. So it's a kind of like a leading indicator of where the market would be. We look at these numbers and say, well, if the pending average listing is up, the sold average sale price is going to follow it. They just haven't closed yet. So based on that, we still see prices going up. That's determining we'll see how the sales to list price ratio factors into that later on, but it's definitely up from a year ago, and definitely over month, it's up 3.5%, which is something to be. It looks like, from all things indicated, we still continue to creep up.
Yes.
And this is why the CPI data looks the way it does. CPI data takes into shelter costs as part of the factor. And again, this little creep up here is going to be something that's going to be watched closely. And I think if it does accelerate to any degree, it started, even in these reports, based on this latest report, we see this increase slowly starting to take hold here. Because, when you see pending average up 2%, sold median listing prices up, people are kind of moving up in their buying, what they're buying in terms of price. How that influences inflation is going to be probably key to moving rates from the Fed's point of view. I would not eliminate the fact that the Fed may increase rates again going into next year. It could be as early as March. We're going to see the next CPI data, but if this continues at this pace, it's likely to trigger inflationary caution that's going to raise rates. This is just my experience of looking at the numbers. So what we got next?
The next is the sold average listing now. So the sold average listing has risen year over year, almost 2%, but it has decreased 3% month over month.
This is one of those things that, this is one of those little, the sold average listing was down month over month, year over year up, which is around the same thing as, you look at the pending and you look at the sold, and you kind of build a correlation. It seems to be sloping upward based on sold and pending. Pending is what's happening more currently. Sold is what's happened. So even though it was down on a month-to-month basis, the year over year and the pending is and the sold, there's a little bit of discrepancy there. And obviously we deal with a small sample size, so there's some anomalies here. But it's one of those things we look for as far as is there a potential for acceleration in the market, prices to move up? And based on this, the difference between the sold median listing and the pending average listing is showing maybe about a 2.3% increase, which is indicative that we may, which, and I think in the latest CPI data, that's one of the things they'll be monitoring. Are they going to make an uptick in rates based on like this little slight acceleration here?
Yeah.
It's a little bit, not much, but a little bit. They really want to keep inflation down under. They like it to be by 2, but this month it was at 2.7. And if it does keep at this rate, I wouldn't be surprised if CPI or the Consumer Price Index start to rise maybe to around 3.1 going into next year, which is not going to be the Fed policy. It's not likely, and it's one of those sticky subjects. But I don't want to get into that now. We'll just keep going with the data. I'll weigh in at the end.
Alrighty. So the new average listing, that is up year over year 12%, but down month over month 3.44%. New average.
People are putting their houses way up over. This is part of the reason why you see price drops. Not so much that prices are decelerating, that people are putting up their houses way above where would suggest the market has been met. At a 12% increase in the new average listing, meaning people are putting up their house for that's a significant jump year over year. It's not reflected in the data that we're rising 12%. It's nominal at 2% year over year, but this year, especially with the pending, it's people are a little over exuberant about. That's really what it's saying. Is that the exuberance level of what we think we can get for our house versus what's happening is kind of excelled past where the sold median listing price is going, almost by 10%. So that's significant. That's significant. People are over exuberant about what's going on.
Mm-hmm. Yeah, and also the sold average sale, that is up 2% year over year, but down almost 3% month over month.
The sold average sale price, yeah, that's an interesting one. That it came down 2% month over month, although it's up 2% year over year. So, based on the pending, I'm not really looking at this to be too. That's going to rise based on the sold median listing price and the pending average listing price. It appears that the month-over-month is an interesting one. But one of the things is that sold average could skew data because we don't have much of a data sample to work with. Sorry for not looking at you guys. I'm deep in dive in looking at numbers. But it's definitely something that we really have to look at moving into the new year. It does look like though prices are gonna, right now I'm hedging my bets on the fact that prices look like they're gonna come up. Because there's some interesting stuff here as you move through. The sold median's up, right? That's the next thing.
Yeah, sold median sales.
What is it up to? 3.5?
Yeah, 3.5 year over year.
And then only 0.8016, well, which is good. You don't want a month-over-month increase. This is more in line of where I think things have gone. 3.5, so 3.5%. Sold median listing price. So prices are up on Staten. I would say that's a pretty fair indicator between the sold average and the median sale price. It's up year over year, 3. So the market gained 3. So the level of appreciation in real estate has definitely slowed. There is nowhere near the amount of desire to pay too much more. 3% by most people's standards is probably to the eye test, not significant enough to say, hey, it's time to buy, or it's time to sell. But this is something that moving forward, you'd want to see you want this seems to be like a fair year-over-year value increase. Fair. If we stay at 3.57, it's definitely a big plus if we could stay at that. But I have a feeling that we're not. There are things in this stat report that says that it's not going to happen. I don't think that we're going to see prices come down. If anything, I think we're going to start seeing a slight bounce here. Based on everything I'm seeing, all the leading indicators seem to be pointing in that direction. But the interesting thing is the next stat you're going to bring us, which is
the active listings. So the active listings are down year over year, 13%, and also down month over month, 6.5%.
So the active listings continue their descent. 6.5% is seasonal, nothing to really speak of. 12% year over year. Active listings continue to be on the decline. So last year at this time, there were 1,467. Now, that, just so you know, that includes the entire MLS, that's not just Staten Island. Those are the outer boroughs. Sometimes this data can be a little skewed if you're just talking Staten Island specific. This does incorporate some Brooklyn in there because people use the Staten Island MLS to list Brooklyn properties, even New Jersey properties, to be honest with you. I have to check on that to see if that's actually incorporated into the sales data.
Yeah.
But 12% is definitely, definitely in active listings is a big drop. Yeah, it continues to be the theme. The next is new listings.
The new listings have increased almost 5% year over year, but it did drop 22% month over month. New listings.
That's seasonal. 22% drop seasonal.
Mm-hmm.
So nothing to report there. It's very easy to see on a month-to-month basis when you see new listings. People just don't tend to list this time of year. New listings 4.64 for the year, up a little bit. And that's reflected in is that when the houses are coming on the market, there's not many active listings, they are selling. So it has given some rise to the amount of sold listings in the last year, which seen some increase.
Yeah, so the sold listings have risen year over year almost 18%, but has decreased month over month 13%.
13% usually dealing with seasonal factors. Mm-hmm. Nothing to write home. 70% in homes sold. So just to give you context, because when we deal with small sample size, it's negligible in terms of like when you look at how low the numbers actually are. Last November 2023, there's 263 sales. Now to give you context is important when you're doing data, because when you do data, one of the things you try to understand is like what this actually looks like in terms of years past. When we talk about 263 sales last year, that is, I go back a ways. These are numbers that you haven't seen since like close to 2009, 2000, even 2010. 263 sales is, now it has bumped up from there, but as just to kind of put that into a measure of like where we are and how far we've kind of dropped in the amount of sold listings, it's actually dropped more than 50% in the span of time from 2021 till 2025. There was, back in 2021, just after the pandemic, 2022, we were talking close to 600 and something sales to now literally half of that. And that's really the key to understanding context. So when we say, sold homes increased by 17%, we talk about in terms of actual volume and numbers, it doesn't take much to draw that higher. And that's indicative of the fact there's more new listings on the market.
The pending listings are up year over year too. It's up almost 39%, but down about 20% month over month.
Yeah, so the last month, and this is the pending listings are up 38%, which is indicative that that's pretty healthy, and that had to do with the latest rate decrease. So the rate decreases have definitely impacted people wanting to purchase. That's how rate sensitive the market is. As we see these rates go down, the amount of activity jumps considerably, and that's big. Like that's a big jump year over year, 38%. So 38% more houses pending today than a year ago. And that's significant because people have locked in rates that were lower, that have been on the lower side of things. I think this past month, you'll see a slowdown now. I think it's reflected in the month over month numbers are down almost 20%. A lot of it's seasonal, some of it's not. It's not necessarily, it's not a popular time to purchase. But, and this is where folks need to understand, is that when you're looking at these pending listings and volumes, so much of this is interest rate dependent that you could really find yourself upwards or downwards based on what the rate is at the time you go on the market and how much it changes. It's a very volatile market in the sense that interest rates are they're really driving values on everything. So that's the entire market is basically interest rate dependent. I think you don't have anything more, right?
Oh, that's all the stats.
Yeah, that's all the stats.
Yep.
So let's get into the synopsis of what I think this means going into the new year. So if you're going into the new year, and what we're really expecting is the CPI numbers, there are things that are outliers, which I consider to be relevant to consumer sentiment. Okay, consumer sentiment. Obviously, there's a new president coming in. There's some optimism, probably a little bit more optimism than I would care to say is like valid. It's a lot more because there are a lot of systemic things within the economy right now that haven't really adjusted themselves to the degree that one person could change the fate of economics. It'd be a nice idea, and some of the things that are being like the reduction in payroll tax and things like that, which these things could be an accelerator. But in the same vein, everything that we do at this point now becomes indicative of where we are inflation-wise. Okay, so inflation is the key. And I said this before, I don't believe that we're in, with the balance of inflation and results is becoming almost a undeniable fact that there's more systemic problems in the economy, because I think because of everything being so interest rate sensitive, it could be alarming if in fact, because there's been damage done so far. The higher interest rates did a lot of things to the labor markets. Labor markets have been absolutely decimated in the last year. It's not been very good. And if there's an acceleration, already the damage is done. If there's an acceleration in inflation again, forcing rates to go up again, we teeter into this place that it's a very, very difficult thing to navigate. And I think that's going to be the theme of going into the new year is that there's going to be a sense of optimism. So I do believe prices are going to go up. The other thing is, with the acceleration in prices, the volume of home sales going up, and maybe what I call the bounce, we still have the same problem that we had going into this last, and I would say it was a recession. We were in a recession for the last, they could say it wasn't. It was by all means technical recession. The stock market was in a bubble market, it was off 20% in 2022 into 2023. It's up considerably since then, but there does seem to be the same things that were driving the inflation in the first place starting to play out again. And I haven't go any further in looking at Bitcoin prices because I do think that's one of the things, if you look at the markets, that seems to be indicative of gold prices. All these kind of asset prices have begun to re-emerge on the stage, moving upward. And these things are what I call indicators, like what's going to happen. In a lot of these instances, what happens is he's kind of being a harbinger for accelerated market. That includes real estate. So the last time, and I always use the sentiment of the other markets to give you an idea of where the market's going, because these are like the lagging factor in the economy is always real estate. Real estate moves slower than the other segments. So you have obviously S&P, you have the NASDAQ hitting all-time highs. This is indicative, and it will translate into real estate. There's no doubt about it. There's a correlation between that. I talked about the Bitcoin price. I talked about how that's accelerated. And if you look back to 2021, the first thing that went up was that was the first phase one of the real estate market. And then then you started to see it trickle into real estate. There were some interesting things that even happened in that time, which was, but there's some concerning things. I'm not going to tell you that off the bat that we should all be celebrating a growth in home prices, because the effective tools that we use to decrease inflation, if they do not work, based on the damage that was done to the economy, and it was pretty brutal. Real estate was really taking a nosedive last year. The year before, in February, 2022 was like when the SVB bank went down, interest rates, banks having a hard time keeping reserves. There were some problems, and now they've been adjusted. But some of the things that have been lagging, which was obviously unemployment's upticked, and the weapons you use to fight inflation have already done some damage. And the question is that if it does reaccelerate, I pivot backwards to even take it this further. And because they will be forced to raise rates. And I do think, I believe this, that they're going to have to raise rates once again at some point next year. And that's, there's no, I don't see it, there definitely will be an acceleration. And this is part of the larger problem with how the Fed is going to manage. There's tools in the toolbox, but sometimes those tools are not big enough to fix. The pandemic situation of closing the economy off and restarting it has really taken, it's like you can't expect to shut off it's like taking someone's heart out for a month, putting it on a shelf, putting it back in, and expecting it to work efficiently. And that's basically what's happened here. There was so much money pumped in. We're talking trillions. I mean, the most money supply added to the economy in its existence was introduced in the pandemic. And this is why we're seeing asset prices fly off the handle. And it's sloshing around, not knowing where to go. Interesting time. That's all I can tell you. It's an interesting time going into the new year. I'm optimistic, though. Somebody would say to me, "You're the most optimistic pessimist." I like to be real. I like to tell people the facts without overblowing, like the realities of what's coming. Because like I told you, everything that happened today, we were talking about it yesterday.
Yeah.
That I told people exactly what happened, and it happened precisely the way I expected it to. I talked to people 10 years ago and said, "This is what's going to happen. It's coming." And guess what? We're here. And it's like, yes, your food price is going to go through the roof. I said this. We still haven't fixed a lot of those things. We'll have to see what happens in the new year, though. I do think for most homeowners here, this is a good news report. It's a good news report for house prices. The question is that there'll be a point where they're going to have to, I believe, going into the next year, you may see another quarter point rise in the rate. But we'll have to see. It's just interesting times. Interesting times. This president is going to have his hands full. He's going to have his hands full. One person doesn't make it. When it comes to economics, I hate to say this, economics is not left to a single person. It's never worked in the past. I don't think it's going to work this time, even though I do think there'll be some things that will be adjusted policy-wise that will help consumers, but I don't know if it's a long-time fix or a short-time one. But let's see how that plays out going into the new year. All right, and if you have any questions, I don't think anybody had any questions today. It was kind of a slow session, but please feel free to leave them on our platforms.
Yes.
All right, and that's where we're at. Have a great afternoon, everybody. We'll see you next week with the
Monmouth and Ocean.
Monmouth and Ocean.
Yes.
Ciao.
Bye.